Hello everybody and welcome to my daily report market analysis videos on Friday the 10th of January with me, Richard Perry, market analyst at Hantec. It is non-farm payrolls Friday and we've got a consolidation. To be honest, in the last few days markets have been very volatile and sort of come with a bit of light relief. I think the fact that we've had this consolidation this morning gives everyone a bit of pause for breath, take stock of situation. And focus on something else, because basically what we've seen is the geopolitical tensions between US and Iran have settled down in the last 24 hours or so, and subsequently we're seeing that reflected through markets. The mild risk appetite improvement has continued to come through. You've got the VIX volatility, which has fallen away. S&P 500, Wall Street breaking out again to all-time highs. This just doesn't stop, does it? Little bit of a correction early in this week, but just bought into again. So just continued all-time highs there on Wall Street, and equities continue to run high. You've got the dollar, which has rebounded actually in the last few sessions, and that rebound has actually held ground again today, interestingly enough. Now the question would be whether that rebound can continue, because there is, certainly on versus the yen, there's a pretty strong correlation between the 10-year yield and dollar yen. So 10-year yield just sort of rolling over a little bit in the last sort of 24 hours. So can that dollar rally continue would be the question. But certainly at the moment there's a sort of consolidation that we've got, I think, in front of payrolls. And once payrolls are out of the way, then I think markets are going to start to look towards next week with this potential signing, and I use the word potential, of the phase one trade agreement between the US and China. Still not entirely 100% sure that's going to be signed on Wednesday, but certainly a fairly sanguine look at how that could potentially pan out. But at the moment we are focused on payrolls. We have the payrolls report announced at 1:30 as per usual, and what we have is the expectation of 164,000 jobs. Got the expectation of 3.1% on average hourly earnings, and also unemployment sticking at 3.5%. So let's have a look at these data, and you can see non-farm payrolls 266 last time out, so that'd be back down below the running average there of the past 12 months on the headline jobs number. Looking at average hourly earnings, just holding 3.1%, but there's been a definite sort of rolling over to an extent in the last few months. But above 3%, I think you're still fairly happy on earnings. And unemployment, which is this one here, just hovering around 3.5%. Also watch out for the underemployment as well. But still a fairly solid jobs report we are expecting today. Nothing too significant in terms of surprises. But 164,000 jobs is fairly much within the run rate of where we'd expect it to be around this point. So that takes me to my chart of the day, which is Euro Kiwi. Now what we've seen in recent weeks is the Kiwi, which has come under pressure, and the euro started to perform a little bit better. It has been under pressure as well, but I think less so than the Kiwi. And you can see that in the fact that Euro Kiwi started to tick higher. You can see a mild uptrend in the past week or so. Now this uptrend is now testing a bigger downtrend over the past 2 months or so, and the resistance of that downtrend comes in around that 68 figure to 68.30 mark, and I think that is a key level, key area that traders I think will be looking out for, because if you start to see the Euro Kiwi closing above, say, the 68.30 mark, which was the old lows from December, if you start seeing closing above that, you're also seeing that downtrend would be broken. You've got the momentum indicators which are already leading higher. Look at those MACD lines, the RSI at 45. We get the crosshair on that RSI. That's at levels not seen for several weeks really, and also the stochastics as well, leading an improvement and a recovery. So the market is sort of certainly contemplating and shaping for a recovery and a breakout, and it just depends, I think, on how the market can close above 68.30, because if you can also see this bearish engulfing candle here, that's a bit of a caveat to the recovery, because obviously that is a negative signal within a downtrend, which effectively is a sort of a signal to renew selling pressure. So yeah, that's a little bit of a signal that muddies the waters a bit, but certainly the momentum indicators of recovery, the uptrend building, the testing of that resistance of the overhead supply, 68 figure to 68.30. If you see a closing breach of 68.65, which was that reaction high from earlier this week on Wednesday, then that would certainly constitute a recovery. But just holding around that crossroads of this resistance now, and it'll be interesting to see how this one goes, but certainly one to watch nonetheless. So with that in mind, I wish you good luck in your trading today. Click here to subscribe to our analysis videos and go to our website to sign up for our webinars, which we have a payrolls webinar today.